Yeah, fantastic to meet everyone. I'm super excited that everyone here is learning Solidity and coding for crypto applications. I learned Solidity when founding Syndicate about 1 year and 5 months ago, a little over. And the progress you can make in Solidity in just a short amount of time is really fantastic. It's an excellent language to work with. So I'm Will. I'm the co-founder of Syndicate. I also was on the core team of Constitution DAO, and I created Adventure Gold for the loot ecosystem. And I got into the crypto space I got into the decentralization space in 2013. I was working on mesh networking technologies at MIT one summer at the MIT Media Lab. And from there, I learned about Bitcoin in 2013, started doing little side projects with it. I made one hacky prototype where you could verify the legitimacy of files on the Bitcoin network. So it essentially would take a file hash, convert it to a Bitcoin address, and then you could send that out from an account that you wanted to have as the verification source. And then the way to just reverse the verification would be for a given file and an address, hash the file, and then check to see whether the address is represented check to see whether the hashed file is represented by the verification address. So that was a cool system that could hypothetically be used for like verifying the integrity of applications, making sure they're not modified, or verifying that data sets are unmodified, things like that. And then around the same time, I was also creating my own coin out of curiosity. It was just the nights and weekends project. Back then you had to download the Bitcoin source code, make the modifications to it that you wanted to make. Oftentimes people would change block time, block height. Some people added proof of stake mechanisms back in 2014. But you'd modify the Bitcoin source code, and then you'd launch your own coin, and you need to find a bunch of miners to secure your network. So you had to secure your own proof of work ecosystem. So many coins did not get off the ground just because they could not incentivize enough miners to join the network. I saw how absurdly difficult this process was. My coin did not launch. It was just it was just like an extremely difficult process to try to make something interesting. And around that time, I discovered Ethereum. So I discovered the Ethereum presale, and I realized, oh wow, you can launch your own token without needing to secure your own network. That was a big innovation at the time, back in 2014. That the idea of a Turing complete system on top of a blockchain was completely new and completely untested. So I did not have much money to invest at the time, but I took the $10 I got for free from Coinbase and I put it into the Ethereum presale. If I'd put $100 into it, I could have bought a house with the money. But hindsight is 2020. And then I've been involved in the crypto space, tracking it closely or prototyping in it ever since. I first came up with the idea for Syndicate in 2018 with my co-founder Ian. We were working together at IDEO, a design firm that does a lot of design consulting on cutting edge markets and products. And I was doing R&D there, and my co-founder Ian was setting up their crypto venture fund. And at the time, we were thinking about Syndicate as how can we build out this kind of like verifiable investing network where your track record is verifiable and people can know the performance of the investments you're making, and where like actions speak louder than words. That was the general framing we had. And in 2018, it was way too early. So that was the depth of the bear market. The only things going on the network were CryptoKitties as an NFT experiment, a few gaming experiments back in the day, which I invested in the ones that are now worth zero, and then also there was also a big focus on enterprise blockchain at the time, something that people still discuss, but is less prominent now. So the ecosystem, and DeFi barely existed. There really was barely any capital in the network, and it was just something that was not really feasible with the technology that existed in 2018. So we kept brainstorming it. I started working as a product manager in the IoT and security space, and then after DeFi summer in 2020, we realized, oh wow, the things that Syndicate wants to do is viable. So we both left. We both decided to go all in on Syndicate, and we founded it in January 2021. Since then, we have set up nearly 2,000 DAOs, which has been an incredibly exciting milestone. We have a team of around 32 people. And then one thing we also do on the team, which is relevant to everyone here, is we train people in Solidity and Web3 technologies on the job. So we just love to hire like great software engineers and then teach them Solidity. And you know, there are people who would join the team never knowing Solidity, and then in the first month they pushed code that handled like $8 million of funds, which was their very first Solidity contract deployment. We had a lot of review on it, of course, but people get a ton of impact. And then also we also have a bunch of people on front end and full stack who learn Web3.js from scratch, learn how blockchains work. So we care a lot about learning and growth. So if you're interested, definitely check out syndicate.io/jobs. Just gonna do that one quick plug. And then yeah, we set up investment DAOs. So these investment DAOs essentially allow anyone to pool funds to buy any asset. There's people who invest in NFTs and tokens, of course. That's pretty common. There's also people who invest in all sorts of things, like for example, we helped Constitution DAO with compliance, and would have helped by the Constitution had we won. We helped City DAO with legal formation, which eventually bought land in Wyoming. And yeah, there's quite a wide variety when we see people investing in startups on our platform as well. So the goal is really to expand access to investing. Syndicate's investment clubs don't require people to be accredited investors. You only need accreditation if the underlying asset requires you to be accredited. So in the US, accredited investor status has certain net worth requirements, usually $1 million in net worth or $200,000 in income over the past 2 years. You don't need that to participate in Syndicate. So we really care about expanding access to investing, and that is one way we do so. I'm going to talk about two things today. They're separate topics, but both are very fascinating, so might as well dive into both of them. One is a history of DAOs, to kind of talk about like how the DAO space emerged, where it came from, where it's going, and then also NFT mint mechanism design. I'll try to separate these out into two separate topics. We might want to do Q&A after each topic, if that sounds good, just to keep things aligned. So I'll start with the history of DAOs and walk you through essentially like where DAOs started in science fiction to where they are now. Before DAOs existed, there's a book written that was essentially the foundational inspiration for DAOs. It's called Daemon, which was written in 2006, and Freedom, written in 2010 by Daniel Suarez. And it was referenced in the Ethereum white paper. Daemon and Freedom were very influential for the creation of Ethereum, the idea of DAOs themselves. And the book envisioned a cooperative economy, but the cooperative economy had a dark side. In Daemon, in 2006, that was before Bitcoin existed. So a lot of the book actually focused on how this network stayed online without any central person running it, which was a lot of the focus of the book. It, like the Daemon, it wasn't called the DAO, it was called the Daemon. The Daemon would hack companies and like say like if you shut down our daemon, we'll delete all your data, so you should leave our daemon running, so keep online. and this daemon was trying to reinvent society, often with a dark side to it. And the fascinating part is that, in 2008, 2009 with Bitcoin, that idea stopped being science fiction. The idea of this autonomous computer system actually turned out to be real, and actually turned out to be one of the easier parts of DAOs. Yes, I'll write them down. Yes, so I put them in the chat. Freedom was written in 2010 after Bitcoin was launched, and Freedom focused less on how the network kept running, because it turned out that was no longer science fiction, and focused more on how this cooperative economy works. So like in Freedom, it's focused a lot on how these individual groups coordinating together can produce results and create a new society without a top-down hierarchy. But whole group is coordinated by an autonomous system of rules, but individuals themselves have a lot of flexibility in how they implement it. So it's incredibly interesting for the science fiction underpinnings of DAOs. Would highly recommend it. Also, every time I talk about it, including at investor days with some of the most talented institutional investors in the entire industry, almost no one's read it. So by reading it, you will know more about DAOs than everyone else. That was pre-Ethereum white paper. So DAOs were defined in the Ethereum white paper in 2013. Essentially DAOs can vote, they can spend funds, and they can modify their own code. That is how DAOs were outlined in the original vision. The interesting part is that defined two types of DAOs, which seemed very unfamiliar at the time, but is actually quite familiar today. One is decentralized autonomous corporations, where one share equals one vote, and they focused on profit making. This looks like a lot of protocol treasuries. This looks like investment DAOs, and this is a structure that we see pretty commonly in the DeFi space. The interesting thing is that it also introduced the idea of decentralized autonomous communities, where one member equals one vote. And the idea was that membership should putting more money in shouldn't change the membership that someone gets. And this is really fascinating because the Ethereum white paper did not anticipate NFTs, but decentralized autonomous communities look kind of similar to NFT communities today. Not totally exactly. Decentralized autonomous communities envisioned that there was a proof of personhood protocol in place where you could guarantee that each member was a unique person. NFTs, you could buy 5 of them from 5 different wallets if you wanted to. But it gets pretty close to what NFTs look like. So there's some echoes of NFTs as DAO structures in the white paper. So that was 2013. Ethereum did the pre-sale in 2014, launched in 2015, and then in 2016 there was the DAO. The DAO was an investment DAO for the Ethereum ecosystem, and the idea was that it would essentially invest in projects on top of Ethereum and act as a way to fund this very new ecosystem that didn't have many people funding at the time. It attracted over 10% of all Ether in existence, including some of my own back in the day. And the idea is that members would vote on ecosystem investments. People could submit a proposal, and the DAO would essentially have a yes vote and a no vote. If you voted yes, some of your funds would get put towards the proposal. If you voted no, you'd keep your funds, and you would be able to use them for the next vote instead. This was a great idea in theory. It ended up being hacked, and the hack led to Ethereum versus Ethereum Classic. So at the time, there were people who believed in what we now call Ethereum, who believed that the bug was unintentional and therefore the chain should be rolled back because it was not something that people that the contract authors intended for. Ethereum Classic, people said, no, the code is the law. If there's a bug in there, that's the intended behavior of the contract. And Ethereum Classic should essentially should never touch these smart contracts. It should be a neutral system, and whatever the code says is whatever the code does, regardless of any bugs. We all use Ethereum now and not Ethereum Classic, so you can tell which side of the debate won, and that helped resolve the code as law debate versus whether it was the intention of the programmer debate in the community. If it had not been hacked, it would have been worse. When I pulled these numbers, it was ETH was higher. If it had not been hacked, it would have been worth about 50 billion at the time I pulled these numbers, but probably lower in terms of USD value now. Bottom line is that it would have been larger than every single venture fund in the ecosystem, possibly every single venture fund combined in the ecosystem, which would have been, the ecosystem would look radically different if that were the case. In 2017 to 2020, the people that was when DeFi started to emerge, and there was a heavy focus on very general composable primitives. So the idea would be that these tools wouldn't really specialize in any one thing, but they could do everything. The two main DAO tools that came out of this 2017 to 2020 era was Gnosis Safe and Moloch. Gnosis Safe is a multi-signature wallet. You can use it to manage funds as a community, and then Moloch is a on-chain governance structure for DAOs, and it essentially lets you submit proposals while still retaining control over your funds. These DAO tools were most of the what existed between 2017 and 2020, and it came from this very composability focused perspective. Just like how DeFi wants to be very general primitives that can interoperate with other primitives, Gnosis Safe, Gnosis and Moloch came from a similar mindset. They didn't have any specialty in particular, and those were the main tools for a while. That was kind of the bulk of the innovation in the DAO space until 2021. 2021 to 2022 kicked off another wave of DAO tools, where we started to see vertical specific DAO tools. There's Syndicate for investment DAOs, Juicebox and Mirror for crowdfunding, Utopia for payroll, Guild for token gating, Partybit and Coop for group NFT buying. You start to see a lot of these vertical specific tools, and these DAO tools have gotten more and more specialized over time, where they try to focus on a use case and they try to build to that use case and do it really well. So if a use case could involve DAOs, it will likely end up with a vertical specific tool. If any of you are thinking of founding a DAO tool, probably look at a use case that exists that don't have a specialized tool for it. Areas that are pretty open are service DAOs and software DAOs. There's not really much tooling for them right now. Essentially, my own personal belief is that DAO tools will start to emerge for every single use case that someone might want to do. Right now, there's a few use cases they've emerged for, but I think there will be far, far more, and that will truly unlock a lot of pretty incredible productivity in DAOs. The best ways to get involved with DAOs, first of all, is that earlier is better. If you join a DAO early, you can likely help shape it. Onboarding to larger DAOs is hard. There's a lot of context. DAOs are sometimes not particularly good at giving that context. Newer DAOs are usually more receptive to contributors than DAOs that are pretty large already. And then find an area that interests you, where it relates to skills that you can contribute. So everyone here probably has expertise in programming, and there's lots of custom tools that you could build for DAOs that could help contribute in a pretty substantial way. And the most important thing is DAOs are decentralized systems. You don't need to wait for permission. You can just get involved. Oftentimes getting involved first, showing people something you made that fills an interesting use case, and then joining the team from there is a good way to go about things. So I'd highly recommend getting involved in DAOs. It's super, super interesting. It's a great way to build skills. And there's lots of DAOs out there that are looking for contributors. So that is the history of DAOs from science fiction through the white paper, through 2016, through like the DeFi era, and through the DAO tool era. I want to open it up for questions now if anyone wants to chat about anything DAO related. I think we probably have around 10 minutes ish for questions, and then I can move into NFT mint mechanism design.
I have a question.
Yeah, go ahead.
Why do you think Moloch DAOs haven't taken off like other, like the compound DAO type? This might be a little specific question that needs context, but it's really surprised me because I think Moloch DAOs are amazing.
Yeah. So for context for everyone here, so there's two types of on-chain governance that you see in common use. Compound governor, often compound governor Bravo is the version that people tend to use, and Moloch DAOs. Both of these are structured for on-chain governance. The key distinction between these two, and I think this also relates to your question, Thomas, is that Moloch DAOs focus a lot on having individuals retain control over their funds. That's their primary goal. So you can do things, for example, where you can rage quit. You can choose to leave a DAO and receive the underlying assets. And you can also if you're willing to be hacky enough with Moloch DAOs, you can even like individually contribute or reserve your funds to specific proposals. So you have a lot of discretion over what you as an individual choose to join in on. Compound governor, on the other hand, is making decisions for the whole DAO. So whatever decision is made is by the majority is the decision that gets passed and implemented. And I think that that's why we see compound governor more in protocol treasuries, is because they need to assume that all of the funds are available for the protocol, and that whatever the majority wants is what they'll be able to execute. Whereas I think Moloch is a much better fit for DAOs that are much more focused on like communities rather than protocols, where you might, for example, think that organizing a conference is a good idea or a bad idea, and want to put your funds towards it, or want to disagree with it. So I think that Moloch is used more for communities, Compound is used more for protocols, but Moloch has not been used for a lot of communities because right now the costs to vote on chain are pretty high. So that's a downside with on-chain governance in general, is that you have to pay. Whereas in Gnosis Safe, you can just vote via snapshot, then the signers execute.
Altan, you want to go next?
Yeah, thanks, Will, for your time. You mentioned at the beginning of the talk that you helped more than 200 DAOs to create a DAO. So how does the distribution look like for you? Like how much, what percentage of them are investment DAOs? How would you sort of categorize the current DAO landscape?
Yeah. So on Syndicate, it's nearly 2,000 DAOs. I can pull the exact numbers right now. It goes up quite a bit each day. So my numbers are always a bit outdated. It's right under 2,000. Yeah, it's 1,922 DAOs right now. On Syndicate, almost all of those are investment DAOs. So there's other investment DAOs out there besides Syndicate. But we're definitely the vast majority of them. So I'd say probably in the DAO landscape, around 2,000-ish investment DAOs exist. That's my best estimate. Deep DAO estimates that there's under 5,000 DAOs total. Some of those investment DAOs are not tracked yet because they're still pretty new. If you assume that the total size of the DAO space is like 7,000 DAOs, then investment DAOs are a pretty sizable portion of it. And I think that'll just continue to grow. I mean, before Syndicate was founded, there were maybe under a dozen investment DAOs in the entire Ethereum ecosystem, from 2016 through 2021. And then we went from under a dozen DAOs in the ecosystem total to of investment DAOs to nearly 2,000. So I think the investment DAO space is growing rapidly, and it's still emerging as a primitive. There's lots of community DAOs as well. You see protocol treasuries, and then you see community DAOs. those are distinct in their own ways. Protocol treasuries definitely right now have the bulk of the assets compared to any other DAO type. Community DAOs probably have the most members, groups like FWB and Seed Club and similar groups. And then investment DAOs tend to be smaller and tend to have fewer members, but who are much more dedicated. So you see a mix of different DAO types. I'd say, yeah, investment DAOs, protocol treasuries, and community DAOs are the three main types right now.
Thanks, Will.
Thank you, Will, for taking the question. I'm curious, like, what's the top pain point you're seeing, like, across DAOs? Doesn't necessarily have to be investment DAOs itself, that can potentially be solved through, like, building a software product for them.
Yeah. I think that there's a number of groups working on DAO onboarding. DAO onboarding is definitely a massive problem. There's good software coming up there, but it's not in widespread use yet. Joining a DAO is very confusing and very complex because a lot of things are not documented. At the same time, also DAO coordination and project management is really hard as well. Trying to run a DAO day to day, it can often be very unclear who's doing what. In the Loot ecosystem, for example, there are two different groups working on a new version of the Loot website. They didn't realize that each other was working on it, and both only realized it when they had finished it. One of them posted in the Discord, "Hey, I finished the website," and it started to go live, and someone else was like, "Wait, we just finished the website too," and they hadn't realized they were both working on it, which is a shame since they could have coordinated their efforts. So yeah, I think the major problems are right now DAO onboarding and DAO coordination. More of the like the people side of DAOs is a lot less solid at the moment.
Yeah, so my question is, you've worked a lot on DAOs. What DAOs do you recommend that as developers we should join? Are they like more protocol focused or community focused? And do you have like maybe top 5 DAOs that you advise at least us to join?
Yeah. So I think there are definitely many great DAOs to join as developers. It depends on your interest areas. If you want to mostly build, for example, front-end tooling and then ERC20 and ERC 721 contracts, community DAOs are a great option. They often have a lot of very interesting front-end and token contract needs. A few, and I think that's. And then so front-end, so front-end and token contracts are really needed in community DAOs. And then in protocols, they often need a lot more hands-on Solidity development. So for community DAOs that I'd recommend there is probably Juicebox has a very talented community. They're great. Olympus DAO tends to have a lot of builders. Of course, the Loot ecosystem is something that I care a lot about. So I'd recommend that as well. And then and those are and then you can also check out Seed Club, which is more of an incubator for DAOs, but you'll learn about very interesting projects through Seed Club. So that's one I'd recommend on the community DAO side. If you want to do more like day-to-day Solidity development of protocols themselves, Index Co-op is definitely the protocol that's the most friendly to new developers. Would highly recommend checking them out. Yes, and then of course Developer DAO as well. I'm not too familiar with what Developer DAO is doing day to day, but they are definitely a very talented group. And then so on the protocol side, Index Co-op, for sure, take a look at them. Trying to think of others. A lot of protocols are very unapproachable to new people, so I'd say Index Co-op. Oh, and then also Olympus. The Olympus community is very accessible as well. On the protocol side, I definitely recommend those two. If you want to make a lot of money, you could make urine vault strategies. Urine vaults essentially let you set up automated trading strategies and take a cut. Anywhere between 1% and 10% can be common, and if people put $300 million in that and you make a lot of profits, that's nice. But it, of course, because there's a lot of money involved, it requires a very high level of sophistication. So you could explore that if you want to do, but it's definitely one of the more difficult things out there. But urine is definitely a harder DAO to contribute to than Index or Olympus, just because it has a lot more history and a lot more context built up. But urine is also a DAO that is known for being accessible to contributors. Oh, you're in like YEARN. Yeah.
Yeah, Will, can you just help us and drop a list of it? Like, I'm not familiar with some things you're saying, like that.
Yes,
Yeah,
yes.
stuff.
I
Maybe
can
if you write the
definitely
name,
put
we'll
the name.
search it on our own. Thank you.
Dhaval.
Hey, Will. Nice to hear your story. So I just wanted to ask a very simple question. That you mentioned that you started something way back in 2014, and then over the years you learned different things, and then Solidity is something that you recently, very recently, considering the Syndicate DAO. So do you think that from the development point of view, your programming language and running the communities and other things that has any kind of influence of designing the DAO protocol in general? Because let's say I've never managed or run any communities in the past. So if I'm building a new DAO, would it rather help to bring someone who has core expertise and kind of understanding around those principles compared to just technical people writing the code and the principles in building up the DAO?
Yeah, I think that's where DAOs and protocols can differ quite a bit. So a lot of protocols are actually built only by 1 to 2 people in many cases. A lot of protocols are built with a ton of independence, and they can just put a useful primitive out there, and people will use it if they like it, and they find it interesting. So protocols, you can be very deep into the Solidity and smart contract side without needing to do much else. You would need to think about tokenomics of how to make it appealing for people to start using that protocol when it's new. But essentially, it's mostly like Solidity, game theory, economics. If you want to develop a protocol, you don't need as much on the community side. If you want to start a DAO that's more focused on bringing ideas to life within communities, then yeah, community management becomes a very important task. And something. I'm also going to add another community DAO, Rock Radio. It's a media DAO that Syndicate helps set up. So yeah, community management becomes a much more important task, and coordinating lots of contributors becomes a much more important task. So I think depending on your interests, you'd either go the protocol direction or you could go the community DAO direction. Both are interesting. I'd say the protocols tend to be more technical. The communities tend to be more focused on like design and user experience. So it depends where your interests are. I guess as a heuristic, it's like if you enjoy front-end engineering a lot, you'd probably like to do a community DAO. If you enjoy back-end engineering a lot, you'd probably want to do a protocol DAO.
Oh, hi. One of our original ideas, I don't know if you're familiar, we were working on a project for this class. Our original ideas was QuickBooks for DAOs. Right, you probably heard this a million times. The big question was how big of an issue that is accounting, bookkeeping, financial management, sharing financial statements transparently in a more real time, and asset management. Are these, you mentioned investment DAOs are a big portion of the community out there, or they make a larger market share of the DAOs out there. Is it a big issue, or is it solved, or is it being solved, or what are your thoughts?
Yeah, it's definitely a massive problem. There's groups trying to tackle different parts of that problem. So Tactic and Utopia are focused on the payroll accounting side. They're thinking a lot about it from that perspective. CoinShift and Parcel are thinking about it from the treasury management perspective. I think that there's some groups working specifically on the accounting side, but there's a few different user segments that are relevant to discuss, which is one is that there are some protocols that have no revenue coming in, and they just have a native token, and they need to manage that native token to ensure they can make it through bear markets like what we're in right now. And that's one category where the protocol is trying to calculate its runway and trying to calculate its burn, and less focused on for example, and that's its primary goal, and it's less focused on, for example, like tracking revenue. Then there's some DAOs that are taking in fees, and there's like various fee modeling groups and parameter tuning groups like Gauntlet, for example, that can help DAOs understand their parameters themselves. Oh, and by the way, on the runway and like burn management side, Llama is a very good option out there. And then there's groups that are focused on more of like the day-to-day of like, how do you process contributor payments, and how do you process like expense reimbursements, things like that, more of the operational DAO side. And that's like Utopia, CoinShift, Parcel, Tactic. So I'd say like the specific day-to-day tasks of the DAO look very different between those two types. And then of course there's investment DAOs where they're not, they're taking in capital and they're making investments and checking those investments. So the specific day-to-day tasks look pretty different between those DAO types. I'd say rough heuristic is that the needs for a protocol treasury, the needs for a community DAO, the needs for an investment DAO are also a good way to split those distinctions. And then I think zooming in on a specific area will give you a lot of insights from there.
Cool. I think we can move on to the next topic.
Sounds good. I'll also just quickly cover the chat question of how and where can we explore the early DAOs that you talked about. So there's 2 books that cover the early history of Ethereum. There's The Infinite Machine by Cami Russo. That covers a lot of the early history. And then Laura Shin wrote a book as well. And she also hosts a podcast as well. And that one's called The Cryptopians. I'll put that in the chat. That covers a lot of the early history of Ethereum and like the DAO in 2016 and things like that. So would highly recommend those 2 books. Oh, wow, cool. Oh yeah, Infinite Garden, right. Yeah, that was a crowdfunded documentary as well. So yeah, let's talk about NFT mint mechanism design. I'm gonna quickly pull up my notes on this. Here it is. Cool, great. Okay, so there's a lot of NFT projects have the problem where they have a lot more demand than supply. So they often want to sell it below the market clearing price to create a really healthy community. Communities are in many cases, their sentiment is tied very heavily to the floor price of an NFT. If their NFT is above if their floor price is above the price they minted at, they feel good, the community's happy. If the floor price is below the price they minted at, they tend to be very unhappy and very angry. And like you can pretty much predict community sentiment entirely based on that. There's NFTs where I track them closely and they've been below the floor price and the community sentiment just turns very quickly. So as a result, a lot of NFT projects tend to price very low. And as a result, because that price is intentionally lower than what they could otherwise charge, they end up with a massive increase in demand and not the supply to fulfill it. So there's 4 different NFT mint mechanisms I'll talk about. The first is flat price. You set a price, it's whatever, 0.02 ETH, and people can mint up to 10,000 of them. And then once there's 10,000, they're sold out. This worked well when the space was early and these mints were not immediately popular. So Bored Apes took about a week to mint out. Blitmaps, an on-chain profile, an on-chain project that's by the same creator as Loot, that took months to mint out. So Crypto Covens, another NFT project focused primarily on representing women, that also took a few weeks to mint out. So you can do a flat price. The flat price, when it's not immediately popular, can work well. But the issue is that as the NFT space became more popular, flat prices started creating gas wars. So NFTs would mint out in minutes, and you would need to set really, really high gas prices. And of course, that gas price would go only to the creator, only to the network between like being burnt and going to miners. And that if someone's spending a bunch of money on gas, that's money that is not going to the creators that otherwise could be. So a bunch of people said that and said, hey, okay, well, if there's a bunch of NFTs that are where people are paying a bunch more money in gas. That essentially implies a willingness to pay. So let's do a Dutch auction. The Dutch auction will ensure that the NFTs are sold at their market clearing price. A Dutch auction is when the price declines over time. You can structure Dutch auctions in different ways. Sometimes, for example, you might say it starts at 1 ETH and it declines every 30 minutes until minted out. Sometimes you could say like it declines if there's no mints for a certain period of time. And then sometimes the Dutch auctions are structured where everyone pays the final price. So there's no downside to minting early, at least not as much of a downside. Sometimes Dutch auctions are structured where just you pay the price you want to pay, and if you mint early, you could end up paying more than if you mint later. So Dutch auctions are like the only foolproof way to have a capped supply and prevent bots, because at the end of the day, you're selling it for the market price. Communities don't like it though. They see Dutch auctions as greedy, and they often push back against them. In the Otherside land sale, for example, where I did tweak thread on contract optimizations that some people might have seen. And the Otherside mint sale for Bored Apes land, it was supposed to use a Dutch auction. The community pushed back. They said it was greedy to use a Dutch auction. Otherside then said, okay, we're not going to do a Dutch auction. We'll do a flat price. And then they still got a Dutch auction. The Dutch auction was just gas with $100 to $150 million spent on gas instead of that money going to Yuga as the creators of it. So Dutch auctions can be controversial, but they're better than a gas war. The issue though is that with Dutch auctions, things often trade at or below the floor for a long time. Meebits, for example, used one, and then they traded below floor for quite a while. Sorry, not below floor, below the mint price for quite a while. And then Art Blocks at the height of the Art Blocks mania was using Dutch auctions heavily, and many of those Dutch auctions did not perform well. So communities don't like them because they think that Dutch auctions take all of the liquidity out at a given price. So what do people do instead? A lot of people do raffles. So they say, okay, we're going to do a flat price, but we'll limit the number of people who can mint at once. And that prevents a gas war. That still leads the question of like, it moves the question of how you allocate a scarce resource one level up. Instead of having it be handled at the protocol level, where you're allocating that scarce resource based on the gas price people are willing to pay, you have to figure out who to let into the raffle. And these raffles are vulnerable to what are known as Sybil attacks, essentially botting. You can make a bunch of bots and snap up a bunch of spots in the raffle. And these raffles tend to end up being botted pretty significantly. There's sites that will construct pre-mint lists that have anti-botting measures, but those can also sometimes be too strict. For example, one mint that I worked on, the pre-mint site had there was like a husband and wife who had signed up together in the same household, and because they had the same IP address, both their entries got removed. It was seen as botting. College dorms and such can also get removed if a lot of people are sharing the same IP address. The anti-botting systems can sometimes be too strict. One more extreme version is to say, okay, well, we'll require people to go through know your customer verification or require them to submit their ID. That tends to work pretty well, except for the fact that people can just then sell their accounts. So in the case of Yuga, for example, they did do know your customer verification, but then people sold their accounts. So like then, people can still bot the mint. They just bought it with accounts that people have sold. The last option, that's my personal favorite, is open editions. So open editions are when you say that anyone can mint over a certain time span. So for example, anyone can mint over the next 24, 48 hours. Xcopy used this for an art drop. Drifter Shoots, you can find them on Twitter. They used it for one of their art releases as well. And then Zora used it for Zorb's, a really cool on-chain art piece. Open editions are great because essentially anyone who hears about it at a time can mint it, but anyone who hears about it later has to buy the secondary. So it has no cap on supply at the time of mint, but it does end up having a cap on the time that you can take. The issue with this mechanism is that early minters are disadvantaged. So if you mint when there are only 10 minted, you don't know if you're getting like 1% of the total supply, 10% of the total supply, 0.1% of the total supply. You don't know because you don't know how many minted will be minted later on. And later minters have an advantage. So one thing you can do is you can have an increasing price over time, either based on the number of mints, which is something that Tiles, an NFT project, does, where the price steadily increases, or you could do it based on time. The Ethereum presale had the price increase over time, so that the people who were buying in early didn't know how much the total supply they were getting, so they knew they were getting a lower price. So open editions are great for preventing gas wars. They're still relatively untested, so we'll need to see how they go. So just a quick summary for mint mechanisms that you see most commonly: flat price, Dutch auction, raffles, and open editions. Flat price works well when things are not popular, but it creates a gas war when things are popular. Dutch auctions are the most reliable method to ensure that a mint has neither gas war nor bodying, but communities tend not to like them. Raffles, you still need to figure out who wins the raffle, and people can bot the raffle. So they help with gas war questions, but they don't necessarily help with fair distribution. And then open editions, people can participate. Early mentors have slight disadvantages, but that tends to balance a lot of the considerations at play. So it's a quick overview of NFT mint mechanisms. Does anyone have any questions about them or want to chat about specific parts of them?
Hi, thanks for all this. This is really interesting. I just had a couple of just specific questions about the open edition side of it.
Mm-hmm.
So it sounds like for that one, it would require that the NFT be basically an unbounded NFT. Like what if you had a set number of NFTs that you're trying to distribute? It sounds like, from what I understand from what you said, it sounds like you wouldn't be able to use open edition, or is there a way of making that work that I didn't understand?
Yeah. So there's an option that's kind of in between flat prices and open editions, which are bonding curves. So where you steadily increase the price, but maybe there is a cap. So the curve you set on the price increase helps determine how this should be structured. So for example, you could say that, like, it's still possible to mint past, say, a 10,000 total supply, but the mints get really, really expensive to the point where it's unlikely that anyone could pay it. Yeah, I'd say that using a bonding curve is a mechanism that does ensure that at some point it will become not reasonable to pay it anymore. You could do, but open editions tend to be flat price. At least most of the ones that have been used have been flat price or free, or like fixed price, I should say. The flat price mint mechanisms are separate. You wouldn't want to set a specific cap supply in an open edition, but you could set the price curve in such a way that it makes some later mints unreasonable to pay for.
Okay, yeah, and that actually does. My second question was based on whether if you would have a price for an open edition or not, but it sounds like, I think you just answered that. So it's basically optional. You could, because it seems like the issue if you do an open edition without a price is then there's the issue of how does the issuer fund their treasury or whatever, but they would have to buy it themselves basically. That seems to be a little bit of a perverse incentive if there is no actual purchase price, if you could just mint it for free. So does that cause problems? Let's say you did have one where it's an open edition and there is no price, but then you have the early people just jump, the creators of the NFT or the really early kind of insiders just hoovering them all up. Is that you see that as a problem, or does that not tend to happen in the real world?
Yeah, so Sorbs is a good mint to study in that case. It was free, it was available on Twitter, but they dropped it at a time when, simultaneously, a lot of projects were dropping in, and a lot of people weren't paying attention. They dropped it right between Christmas and New Year's. So, there are lots of people on vacation, but also lots of people who are not thinking about trading crypto right then. So Zorbs had about, I think, 55,000 minted total. In theory, the creators of an open edition that's free could make money off the secondary sales by taking a percentage of royalties. I don't think they take any cut of Zorbs. And then the gas price made it so that, like, there wouldn't be a ton minted. I think the gas price of each Zorb was like $50 or $70. So like there was still some upper bound of the number that you'd want to mint. But like X copy was an open edition with a mint price. I'd say the majority do have a mint price. There's just a few that don't, and that's more experimental, where you have to make it up on secondary sales.
Got it. Thank you.
Mm-hmm.
Blessing?
Hi, Will. So my question is around EIPs that are coming up with new ways of gas optimization. For example, just like EIP 721A, which basically is trying to mint a lot of tokens at the price of one. So what's your thoughts on that?
Yes, there's two interesting ones to study. One is exactly what you mentioned, 721A. So 721A, for everyone here, essentially, instead of encoding a standard 721 says this person owns NFT ID 1, this person owns NFT ID 2, this person owns NFT ID 3, and then you have to write the data each time. 721 realized, hey, a lot of groups are doing multi-mints, so you might be minting 4 or 5 at a time. And instead, 721 stores a range. So it says, like, for example, NFTs 1 through 5 are owned by this person. So it decreases costs substantially when storing a range. There's also another option made by Galactic. It'll take me a minute to find it, but it's another one that you can study, which is another proposal that they made, and they made it after looking at 721A. So you can take a look at both those standards. Both those standards help with optimizing mints. I think that both are definitely good ones. And then I also
So what's that EIP?
Yeah.
What's the EIP? What's the name? You just said it's made by Galactic. That's all.
Yeah. So they call theirs a 721S.
Okay.
Yeah. So like here's their GitHub repo, for example. So you have 721A and 721S are the two common ones you see.
Thank you.
Mhm.
Can you explain a little more, just fundamentally, how the flat pricing leads to gas wars?
Yes. So let's take, for example, the Otherside mint as an example. So Otherside, it was minting for, it was priced an 8 token, but like let's just abstract that away. It's like, let's say Otherside was minting for 2.5 ETH, for example, and it was a very highly anticipated mint, and Otherside has set a price below what they expected to trade at. Price discovery is also very hard. It's like but Otherside set the price at a lower price than what people would pay on secondary. So as a result, it's basically free money in people's eyes to mint, because since the price is lower than what people are willing to pay, as long as you can get your mint in, it's free money for you. You can flip it immediately on secondary. There's many bots that will mint on primary and then immediately flip for 2x on secondary, and that's a pretty common bot strategy that in NFT bull markets. So in that case, what you run into is, because it's essentially free money, every single person wants to mint, the gas price shoots up, and then the gas price essentially defines the difference between what it's minting at and what people are willing to pay. So that's the issue, to kind of have this like stampede all at once, because everyone knows that it's a good idea to mint it.
Thank you.
Yep. Cool. I need to head out for now. This was a fantastic conversation. I'll drop a link to Syndicate's jobs board. Absolutely apply to anything you're interested in. And then also feel free to reach out to me at will@syndicate.io. You can also find me on Twitter at Will Papper. Yeah, so feel free to reach out afterwards with any questions. And this has been a fantastic group. Thomas, I know we didn't have time to get to your questions, so feel free to, and Prasad as well. So feel free to send me a message afterwards. Thanks so much.
Yeah,
Talk to you all later.
thanks a lot for your time. Yeah, see you.